Hello and welcome to the Homebuyer Workshop. This is the lending section of the workshop. I'm Mike Stover and I spent 20 years as a lender in the mortgage industry. I no longer do mortgages. I stepped away from lending because I saw so many buyers working with real estate agents who didn't know what they were doing, or they were pushing buyers to buy a house they shouldn't be buying for a commission check. So I stepped away to run my own real estate company. But I can teach this workshop because this is where I started my career. Oh, and by the way, I know who the best mortgage lenders are to work with. If you've not watched the real estate section of this workshop, please make sure you do. As important as the lending section is, without watching the real estate section, you'll not see how this all ties together. If you did watch it, great. Now you're ready to get educated on the ins and the outs and the do's and the don'ts of getting a mortgage loan in today's market. So let's get started. Getting a mortgage loan. A lot of people are nervous about this. They self-diagnose. They get nervous. It's like, how do I do it? So this is what I'm going to do. I'm going to help you understand this whole process in an easy to understand way. So here we go. How do you go about buying a house and where do you start? So follow along here with me, would you? Okay, this is what we're going to cover. We're going to cover a lot, but I just wanted to put some bullet points out here for you. We're going to talk about the loan process. We're going to talk about home buying mistakes. We're going to talk about the 4 things that a lender is going to look at when you get a pre-approval, okay? I'm going to talk about some red flags, some things that are important that you need to be aware of. I'm going to talk about credit. I'm going to talk about budgeting. I'm going to talk about interest rates. I'm going to talk about loan programs and so much more, all right? So, first of all, let's talk about the home process. Follow along with me. So, the first thing you're going to do once you go through this workshop is that you're going to go ahead and you're going to start interviewing. Yeah, actually interviewing lenders to see who you want to work with. You're going to compare what they're offering you for rates, terms, all these type of things, but you're looking for someone that you feel you can put on your team. Very important. Then you're going to get your pre-approval. Then you're going to get your loan options. What type of loans can I get? What am I approved for? Then you hire your real estate agent. All right? Then you hire your real estate agent. Your agent is introduced to your lender, and then you triangulate and you start working together. You're going to get out and you're going to start looking at houses that meet your wants and needs within your price range that you are comfortable with. Coming back around, you're going to make offers. You're going to make an offer. You might make many offers. Then once you get into contract, you're going to get the home inspected. And after the inspection period, the lender is going to order the appraisal for valuation. And then you're going to get your final loan approval. You're going to go over to the escrow company. You're going to sign your final documents. It's going to record. You're going to get the keys, and congratulations. That's the process right there. Now, to start with the first mistake, okay, not being pre-approved. There are so many people that start looking for homes before they actually know what they can or cannot buy. So that's where we're going to start. We're going to talk a little bit about the difference between getting a pre-approval and a pre-qualification. So let's start here. A pre-qualification is simply where you can go on, you talk to someone, they might take your social security number, they might run a credit check on you, they might not. You're telling them how much you make, how long you've worked different places, you give them a little bit of information, and based upon that, you get this pre-qualification. It's worthless. It is absolutely worthless. And so that's a pre-qualification. You do not want to be meeting with a realtor with a pre-qualification. And a good realtor is going to see what the difference is, and they're going to have you go back and get a pre-approval. All right? They want you pre-approved. Now, there's 2 different levels of getting a pre-approval. A lot of people don't know this. All right? You can sit down. You can give your social security number. You can get a credit check pulled. You can show them your income documentation, a length of time on the job. You can give them all of that. But this is where they're doing it in what they call a desktop type of a module to say, yes, we've got an approval for you and you're pre-approved to do this. But getting totally pre-approved where you're underwritten, this means you have got an attache case full of money. You've got the big check. That's what you're looking for. Get that fully Pre-underwritten, pre-approval. I'm telling you, you can close in the matter of 15, 20 days with something like that. All you have to do is find a good property, get in contract, clear title, a good appraisal, an inspection, of course, and you're good to go. So that's what's powerful. That's what sellers are going to be looking for. So I thought I would share that with you. So there's a pre-qualification. You can get pre-approved, but you can get a pre-approval that's fully underwritten. So try to go for that one, and then you're ready to go. All right. So some best practices here. All right. So get pre-approved. If you're looking, as you can see down here, to plan to buy in the next, I would say, few months to 2 years, do it now. Do not procrastinate on this whatsoever. It gives you a head start on any qualifying issues that might be there that you're not aware of, and it gives you time to correct those. Now, with that, now you want to find a lender. And what you want to do is you want to make sure that you find someone that you have confidence in and you can trust. All right. Now, check their reviews. Check the reviews. Does the loan officer have mostly 1 stars or 5 stars? Then sit down and ask him these questions. Here, go through them with me. Okay. How long have you been in the business? What do you do if the loan gets difficult? What's your availability? I'm telling you this right now. If they're working Monday through Friday and you can't get a hold of them Friday night or Saturday or Sunday, you're going to be in trouble, because that's when a lot of sellers are going to be reviewing offers. You're going to be out in the field looking at houses, and you're going to be touring. And if your realtor needs to get a hold of your lender and they can't get a hold of them until Monday morning, you could miss out on that perfect house that you've been waiting for, and somebody else scooped it up and bought it because the loan officer wasn't available. That's really important. The next thing is, do you have references? How are your rates? You should ask them about their interest rates. Are you hourly, salary, or are you commission? You should ask them that too. Don't be afraid to ask these questions. A good loan officer, as it says down here, should be able to provide a cost sheet. Especially, ask them if the rate if the rate sounds too good to be true. I think that's really very important. If in doubt, call me and I will get you in contact with some good loan officers. Okay. Now, with that, some red flags. If you got a loan officer that states that their rate is a quarter or a half a point lower than what you're hearing out there, but they're not going to show you the rate sheet or a screenshot or a loan estimate, you got a problem. That's a red flag. A loan officer that doesn't return your phone calls, you got a problem. A loan officer that doesn't sound confident when they're talking to you or telling you about something, they shouldn't be fumbling over their words. They should be able to be direct, be able to explain it, and really listen to you when you're asking these questions and make sure that you understood them when they gave you the answer. All right. A loan officer that gives you a quick pre-approval, for credit scores that are under 620, you want to be fully underwritten, as I said before. They struggle with explaining basic terminology. They're high pressuring you. They don't want to talk about their fees. These are all red flags. They overpromise. In other words, they lie. Yeah, there you go. Those are red flags. Buyer beware. Now, once you decide on who you want to work for, or you want to work for or work with, I should say, what you want to do is you've got a 14-day window period to be able to have your credit report pulled. So what that means is you get it pulled once and you're going to get what they call a hard pull. It's going to be a hit on your credit, okay? But you got 14 days to shop around. That doesn't mean you have to go out to 5, 6 different lenders. You should be doing your interviewing process and figure out the 1 or 2 that you want to get pre-approved with. That's when you set up a meeting and get in there. Either you go in person or do it online with them, but you get pre-approved. Now, this is very, very private. It's confidential and it's candid. So you're going to fill out an application. You'll fill it out. Be honest, be truthful, fill it out. You're going to be asked for supporting documentation to back up what you wrote down. I'll go over that checklist in just a moment. They're going to review your credit with you. They're going to discuss with you what you qualify for. All right, they're going to tell you what you can qualify for. Please make sure you find out what your maximum is. Whether you would go up to that or not is beside the point. Then find out where your comfort zone is. What price range are you comfortable with a monthly payment? Okay, that's important. And your realtor needs to know that too. Just because you're approved for $1 million, but you don't want to spend that kind of money. You'd rather stay around 500,000, 600,000, or 200,000 or 300,000, wherever you live. The point is that find out your comfort zone. Find out your maximum, then your comfort zone. I'm sorry to keep repeating myself, but being on the real estate side, representing a buyer and being out there, I need to know those things to be able to negotiate. Now, make sure you have a clear understanding of the loan options that are being presented to you, okay? All right. Now, and if you're not, keep asking questions, all right? There you go. Now, this is some of the documentation you need to get ready for. So get it ready, all right? You're going to need a copy of a current driver's license, 30 days paycheck stubs, 2 years of your W-2s or your 1099s. If you're retired, they're going to need a copy of your awards letter, 2-year tax returns, 2 years of your tax returns. And if you're in business for yourself, they're going to want personal and your business returns. 2 months bank statements, all pages. So you don't give them page 1 and 5 when it's really there's 1 and 7. Even though page 6 and 7 doesn't have very little on it, you give everything, all right? You know, they need to know about your student loans. Get them the information that's necessary. You know, your 401k, your investments, anything that way. If you're in the military and you're non-active, they're going to want to see your DD-214, or they currently want to see your COE if you're currently in the military. Now, if you're divorced, they might want to see your divorce decree. And they might want to see any DSHS paperwork, especially if there's child support, things like this. And then, obviously, if there is any judgments or tax liens, they might want to see whatever payment plan you have set up if you have one. So there you go. But I would say the most important things to get started with is, of course, your driver's license, 30-day paycheck stubs, 2 years tax returns, and your bank statements. That's what I would get you prepared for right now. Okay. Now with that, there are 4 things that lenders are going to look at. They're going to look at your credit, they're going to look at your income, they're going to look at your debt, and they're going to look at what they call your debt to income. So let's go ahead and start with credit. Understanding it, all right? There are 3 bureaus out there. There's Experian, there's TransUnion, and there's Equifax. Now, if you look at kind of the little chart there, what makes up your credit score, you can see that. 30% of it is going to be what? It talks about the amount you owe, all right? 30-year payment history, you know, new credit you've opened, you know, the length of time you've had the credit. So these are the things. So what we're trying to do is get you an idea that we're looking for a credit score. This is what's going to happen. Each one of these, when the lender pulls your credit report, each one of these credit reporting agencies is going to give you a score. Now, here's something I want to explain to you. A big buying mistake is this. Assuming the credit score a consumer direct company has provided you with is the same thing, the same score that a mortgage company is going to use. They're not. They're going to use the FICO score. So I'll give you an example. If the FICO score is 700 at Experian, TransUnion is at 680, and then Equifax is, let's say, 695, they're going to take the middle score, the 695, and that's what they're going to do with pre-approving you. Now, if you're buying a home with someone else, your wife, your spouse, whoever it may be, they're going to take the middle score, the lowest middle score. So that's important that you know that. But it's really important that if you're looking at the Credit Karmas and the different stuff that's out there, please remember what the mortgage company is going to pull when they pull that credit report. They're going to pull a different score, and it's called the FICO score. All right? Now, let's talk a little bit about credit tips and how to improve, all right, and what it's all about. So first of all, they're going to be looking for 12 months of clean credit with no late payments whatsoever. Keep the credit card balances below 30%. It's really important. It's amazing. I've seen people be able to improve their credit score by 20, 30 points just by paying down the credit card to where it's below 30% of the credit line. So an example, if you have just a simple example, if your credit limit is $1,000 and you have $500 on it, talk to your lender. He or she might want you to pay it down to about $298. And that can boost your score so quickly, it's amazing. That's what I'm talking about. 30% of what your credit line actually is. All right. Avoid closing accounts that have been open for years. Before you do anything, talk to your loan officer, the person that you've decided to work with. Don't try to self-diagnose. Please don't do this. People are doing it all the time, and they've lowered their score so far that they're not able to buy for a while. So again, talk to your lender. Okay, now some red flags. The first one is 30 days late rental history. You pay your rent on time. They don't want to see any lates on rent. They don't want to see any derogatory credit following a bankruptcy. That is just terrible. All right, just so you know that. No derogatory credit. The next one is numerous collections over the past year. Now, medical collections are out there, things like that. But again, talk to your lender because again, some of the things can be overlooked. Underwriters will go, okay, we understand that. Then again, they might say, no, we need those paid off. But again, they will give you direction on what to do there. Judgments, IRS debts, very important. These are red flags an underwriter is going to see. Any potential problems that could actually hinder a person from repaying the debt. Let's say that they do, and then they're going to send out an employment, how can I say, they're going to make sure you're working where you're at, all right? They're going to do the inquiry there. And what happens is, let's say the employer says, well, we don't know if we're going to have a lot of work there. That would be a red flag. That doesn't happen a lot, but what if you work in the union? Maybe you're a seasonal worker. That could be something that they're going to look at a little bit closer. They want to make sure that you're consistently, if you're getting laid off and then coming back to work, they want to see that pattern over a number of years, okay? Just so you know. Now, let's keep going with that. Gaps of employment over the last 2 years. With the pandemic, there were people that were out of work, but they are going back to their regular jobs. Underwriters are going to understand that, all right? Overdrafts. If you've got overdrafts or NSFs checks, again, on your bank statements, they're going to say, what's going on here? Why is this happening? Large cash deposits and transfers. You got to have a paper trail for that. You're going to have to be able to explain that. Another one is too high of a debt to income ratio. That is one thing that I'll be talking about, so you'll understand what I mean by that. But they want to make sure that you can actually afford this house. And then if they see something, property defects, and repairs that need to be done, an underwriter can look at that and say, hey, we need to talk about this. It can hold up you buying a home. So these are some red flags I thought you might want to be aware of. Now, let's talk about income. Lenders are going to look at your gross income before taxes. They're looking for a stable 2-year employment history. They will look at overtime, bonuses, commissions, and second job income. But it has to be a 2-year consistency of it being level or going up, not where it's going down. 1 year you're up, 1 year you're down, all right? Just thought I'd share that with you. But that's the income. That's what they're looking at. The next one is debt. All they're going to do is look at your installment debt and your revolving debt. Now, they only care about your minimum payment. So if you've got a car payment, you've got an installment loan, car payment, and the payment is actually only $200, but you're making $500 a month payments, they're only going to qualify you with the $200, not the $500 that you're actually paying, just so you know that. It's the same thing with revolving credit, your credit cards, things like that. What happens is you might be paying $200 on a $25 a month payment. They're going to qualify you on the $25, not the $200. Okay. Also, collections and judgments, they're going to take a look at that, and depending on what they are, they might be including that in the ratio, and maybe they won't. So the other thing is you'll see a note down here, a non-borrowing borrowing spouse, debt will be factored in most cases when applying for a government-insured loan, such as FHA, VA, or USDA. Now, what can you afford? Let's talk about debt to income. This is really, really simple. Are you ready? You take what your house payment would be, plus your revolving and your installment debt minimum payments, added together, divided into your gross monthly income. There you go. That's how it works. Let me show you. Here we go. Here's an example. You make $4,300 a month. We're going to take 45%. That's going to be a 45% DTI, debt to income. You're going to be allowed $1,935 for a total debt allowed. That means your house payment, a car payment, a credit card, if that's what you have there. So you're going to be, all you've got left is $1,715 is the most you're going to be allowed to put towards a house. If you make more income, your debt's lower. It can go up, it can go down. But typically, the debt to income is between 45 to 50%. There are exceptions. There are. But it's going to be on a case by case situation. Okay? That's debt to income. Now, compensating factors. Lenders are going to look at this. First of all, you've been on your job for a long time. You have a very low debt to income. They're going to lend you more. Excellent credit history. You've got solid cash reserves. You've got savings. You might have a 401k, IRA, SEP. Who knows? You might have some really good assets out there. Likelihood of a future pay increase. Employment verification. That's what I was stumbling about before. On the employment verification that the lender sends out to your employer, they could be saying, absolutely, they've got a great future with our company and there will be pay raises. That's really positive. You might be able to put more money down. Lack of payment shock. What that means is, payment shock, a lot of people don't understand that. Okay, let's say that right now you're paying $1,900 a month or $2,500 a month for a rental, wherever you're at. And now all of a sudden, you're going to be having to make a mortgage payment of $2,800 a month. Now you can do that and you're comfortable with that, but there's a shock there because you've gone from $1,900 to $2,800. And that is what they call payment shock. Are you able to show the underwriter that you can absorb that difference very easily? All right. And that's why we're looking at this. A lack of payment shock, yeah, you're great. That's a great compensating factor. And then another one a lot of people aren't aware of is you attended a homebuyer workshop like this. Underwriters love knowing that. All right. So there you go. Now, what makes up a mortgage payment? Let's talk about this because I think this is important. Okay, so let's start off with this. Principal. It's a percentage of your payment that's going to be applied towards your loan balance. Now, what I mean by that is that when you make your payment, it's going to be broken into principal and interest and property taxes. There's a number of things that a portion of that payment's going to go towards. One of them is the principal. As I just said, that's the little bit that's going to go down and pay off. So if your balance, your mortgage balance to begin with is $300,000, every month that starts going down. The next is the interest. In that payment, you're paying interest. That's a percentage of the payment that goes back to the lender or the investor that loans you the money. The property taxes, and every home has taxes, property taxes. They take 1/12 of the property taxes, and they're annual. They take that, and each one of those goes into a reserve account. You can read this right with me. So the lender can pay your property taxes when they come due. You don't have to worry about that. So taxes are due in April and October. There you go. It's taken care of. Then you've got homeowners insurance. Homeowners insurance is an annual policy, an annual fee, all right? And what happens is 1/12 of your annual homeowners insurance, and by the way, it's also called hazard insurance. So if you ever hear someone call it hazard insurance and you're like, well, what's that? It's the homeowners insurance. That money goes into the same reserve account, and when the insurance premium comes due, the lender pays for that. Now, this is one thing I want to talk about. It's called mortgage insurance. Whenever you put less than 20% down on the purchase of a home, lenders are going to require some type of mortgage insurance. Now, VA won't have it. VA won't have it. All the others will, just so you know this. I want you to hear that right now. So it's a percentage that you will pay each month. It isn't in case something happens to you. This is in case you default. You don't follow through with your obligation of buying and paying for this house on time, and the lender calls the note due, then this is the insurance policy that guarantees them that they'll be made whole. Now, depending on the loan program you've got, depending on it, once you reach a 20% equity position, then you can petition the lender to remove your mortgage insurance. I'll talk about those loan programs that allow you to do that, okay, in just a little bit. But that's mortgage insurance, all right? So if you put 20% down or more, you won't have mortgage insurance on certain loans. On other loans, you will. Okay, so homeowners dues. If you buy in a homeowners association, that isn't part of your payment. You pay for those homeowners dues separately outside of your mortgage payment, and you'll pay that to the homeowners association. There you go. That's what makes up a payment. Now, another mistake, using an online payment calculator. If you're home right now and trying to figure out what a payment will be, stop doing that because it's not accurate. It's not accurate information and it's misleading you. All right. There's too many other little things that go into that to give you an accurate mortgage payment. If you want an idea, yeah, you can use it if you want, but you could be way over. You could be $200-300 over, which could determine whether you might even start looking. So again, talk to the person that you've decided to work with, the lender, and ask them if they would give you some breakdowns of payments would be based upon, if you're going for a $400,000 home, let them know that go up by $10,000 increments up to 430 and then go down by 20,000, just so you know what that swing will be, all right, in payment. Okay? Now, from there, another mistake, not being 100% clear on where your money's going. And we're going to talk about budgeting, something that people don't like to talk about. All right? It's your cash flow. You need to track your spending. I want to tell you a story if I can. It's about me. I didn't get my first house until I was 42 years old. And I'm telling you this story because it's something that I regret deeply. We lived in a little 2-bedroom, 1-bath home in Auburn, Washington. And the rent was $500. And my wife would come to me and say, honey, the kids are getting older. We really need to think about buying a home, getting a bigger home. And I would say to my wife, Ruth, please stop pressuring me. We struggle making a $500 a month rent payment. How in the world am I going to make an $1,800 a month house payment? And this was back in the late 80s, early 90s. Seriously. And you might be going, wow. Yeah, wow. It's no different than what people are saying today or thinking. That financial pressure, that fear, everybody has it. I wanted to share that with you because Ruth went and took a budgeting class. And when she did, she came to me and she said, would you do me a favor? Had tears in her eyes, and she said, I won't ask you again to ever buy a home if you'll do this for me. And I said, what is that? She said, I want you to track your spending for 1 month. Would you promise me that you do that? I said, absolutely, I'll do that for you. Well, I want to tell you this. I could have paid 2 different property $500 a month. I could pay 2 rents, and I could probably have bought 2 $1,800 a month houses. That's embarrassing for me to share with all of you, but you know what? It's true. More people spend more money from Friday night until Sunday night at 9 o'clock than any other time on many, many things. I'm not here to judge anyone, but I took a look at just what I spent on Starbucks coffee over a 10-year period, and it was like $13,000. I've got a great Mr. Coffee machine, really great machine. I save a lot of money. The point is I never knew. I never knew how to do it. But now I do. And that's why I'm talking to each and every one of you about track your spending. Put a spending plan together. If you really want a home, and you want to stop paying your landlord's mortgage, then guess what? You have that opportunity. But you got to start somewhere. And the other thing is stick to it. Stick to it. Look at that as if you all got to come together and say, this is what we're going to do. We're not going out to eat 3 times a week. I'm going to make my own lunch. We're going to food prep on Sundays for food during the week. All certain things. This is how you start. All right. Now, with that, here's some budgeting tips. Take 10% of your paycheck. Put it away. If you get bonus or overtime or your tax refund comes in, put it away. Put it away. Here's the other thing. When you pay off a debt, or get a pay increase, divert that extra cash flow into a savings. Put it somewhere, invest it. The other thing here is make an extra payment each year. Just by doing that on your mortgage, you can take 7 years, approximately 7 years, right off the life of a loan. And I'll show you more tricks if you'd like on how to really accelerate and get a mortgage paid off. And resolve yourself to this, only use your credit cards on essential things or emergencies only. These are a few of the little things I can share with you, but I'm telling you, budgeting is the key. There's a lot of key things I've talked about so far, but I wanted to share that with you, all right? I won't tell you that, yes, we own homes, okay? So, and guess what? And they're affordable, and that's what it's all about. So, confidence. When you're diligent in tracking your money, you're going to feel much more emotionally confident when you make an offer to buy your first home or any home. I wanted to put that up for everybody. Now, here we go. Let's talk about interest rates. I don't know if you can really see this chart very well, but this chart is from 1954 all the way up to 2020. Now, that's what I wanted to share with you. Now, how many years in the past 58 years have rates been below 5%? Well, I put the answer up there, 34. 34. And how often does it look like it's gone below 4% in those years? 16. Rates are going to go up, rates are going to come down. It's just how it's always worked. And in my 30 years of being involved in lending and real estate, I've seen 3 different market changes. So I thought I would share this with you there, but now is what I want to talk to you about. Be aware of interest rates being advertised through television, radio, internet, social media, texting, all the different ways that are out there. I want you to be careful about this. Lenders that quote rates do it to get your attention. It's misleading you to get you to work with them. And you don't know what you don't know. Well, I do, and that's why I'm sharing this with you. Your loan officer, your lender who you're working with will give you the rate that you qualify for. Not all of you are the same. You're not. Someone with a 750 credit score and someone with a 680 credit score are going to be quoted a different interest rate depending on even the loan type you get. So when I hear all these things out there, I just shake my head because it's so misleading. It's so misleading. So interest rates move up and down. They can move hourly, daily, weekly. It's moving all the time. So with that said, make sure you and your lender are communicating frequently in regards to what's happening with the current interest rates, okay? Very important. Now, this is something I want to point out. I want you to read this if you would, please. When you are being quoted an interest rate, I want you all to promise me that you'll remember this. You ask this question. What is this interest rate going to cost me? Can you remember that? What's it going to cost me? Here's an example. I thought you'd find this very interesting. I'm sorry that I typed it out and we're going to read it, but I think it's that important that I go over this because buyer beware. The actual interest rate that you qualify for, let's say, is 4.375. But you're being told, or you're hearing, that 3.375 is available. What you're not being told is the cost to get that 3.375 is going to cost you 2.5 points. Now, on a $450,000 purchase, that's going to cost you $11,250 in addition to what I'm going to be showing you about your down payment and closing costs and your prepaids. I'm going to be talking about that in a minute. Okay? And I wanted you to hear that. The difference in the monthly payment, are you ready for this? The difference in the monthly payment between 4.375 and 3.375 is $249. Now, if the cost is $11,250 to save $249 a month, it's going to take you 45 payments or 3.7 years before you break even, before you even break even. If the average buyer is only staying in a house for 3 to 7 years, does it make sense to spend that kind of money? And the answer to that, I don't know. For me, absolutely not. I always look at the par rate. Remember what I said, par rate. I want a rate that isn't costing me anything. Then I can compare. Because if you go online and you type in the bank, what you don't see in the small print is how many points it's going to cost you. Now, there are justifiable reasons to buy the rate down, to buy it down. But before you ever pay the points to get a lower interest rate, talk about it with your lender. The do's and the don'ts, the ins and the outs. All right, please? Now, locking your interest rate. Typically, every lender is different with this, all right? So typical lock dates are 30 days, okay? You can get a 10-day, a 15-day, a 30-day, 45-day. Some of them might even go out to 60 days, even longer. But that's on a case-by-case basis, and it could cost you money to do that longer. So make sure you talk with the lender about that, please. All right, very, very important. But yes, when do you lock in the rate? Boy, I'll tell you, I see sometimes people get into mutual contract and they're locking the rate right away, and we haven't even gotten into the inspection or the appraisal yet. I really feel comfortable, if the rates are going to be steady for a little bit, just let it float and then lock it. Once the appraisal comes in and we're good to go, lock it. Put the lock on it and let's go. But again, talk with your realtor, talk with your lender about that. This is really serious, okay? Because if you say I'm going to do a 30-day lock and you don't meet that lock requirement, they might be able to extend it, but then again, it could cost you some extra money that you're not prepared to bring to the table. All right. Now, with that, let's talk about loan programs. All right, this is fun. All right, the first one is called conventional. Now, also you'll hear it called conforming. See, these are the little things you don't hear. It's like a conforming loan, conventional, what are you talking about? They're both the same. Conventional, conforming. Typically, you have to put 3 to 5% of the purchase price as a down payment. The seller can actually contribute 3% of the sales price towards your closing costs. So if you're negotiating and saying, hey, would you pay, on every $100,000, that would be $3,000. So would you pay my closing cost? Now, 20% down payment, if you put that down, there's no mortgage insurance whatsoever. Now, remember I talked about that in the breakdown of your payment? There's no mortgage insurance. On a conventional loan, 20% down, no mortgage insurance. Now, the other thing is debt to income, all right? Now, you'll see 43%. The max depends on your lender. You might be able to go up to 55%. You might not. But every one of you stands by yourself on this, all right? So remember, we're just going to say 43 to 45%. Good credit, that's where you would be on debt to income. Also, conventional loans, conforming loans, they can work with a down payment assistance loan. I just thought I'd let you know that. Now, I'm going to talk about DPA programs here in a little bit. Now, it does not require a non-borrowing spouse debt to qualify. I thought that was important because I mentioned that before. I wanted to bring that up. You don't have to do it on a conventional loan. Now, loan amounts. $647,200 is average throughout the United States, but in high-cost areas such as Seattle, I should say this, King County, Pierce County, Snohomish County, certain areas, and this is throughout the United States, there are high-cost areas, you can go as high as $891,250. Yep. Now, credit scores, are looking at credit scores 620 and above. There you go. That's conventional. Those are just the bullet points there. Now, let's talk about a federally insured loan called FHA, Federal Housing Administration. This is the cavalry. FHA has been there to be able to help people that might not have the greatest credit. They might, their income on a conventional loan only allow them to go up so high, but this will let them go up a little higher as long as you're comfortable with accepting that. And they're flexible. It's a flexible loan program to help put people in homes, get you in. Seller can pay 6% of your closing cost in prepaids. And it allows for non-occupant co-borrowers. It's one of those programs that says, let's say that mom and dad want to help you. They don't have to live in the house, but they could come on as a co-borrower with you to be able to get you that right house. I'm just giving you as an example there. And again, the loan limits. Currently, they are county specific. This is very important that you hear me. County specific. So before I say, oh, here are the loan limits can go for $420,000 all the way up to $891,000, depending on the county. Okay, I want to make sure you heard that. And credit score, look at that. Credit score right there. 580 and above. There are people that think they can't buy a house because they've got a 580 or a 590 credit score. Not at all. There you go. Now, I want to explain this. Upfront PMI and monthly for the life of the loan. What am I talking about? Because it's FHA, it's an FHA, government insured loan, you will have mortgage insurance no matter what you put down. And it is for the life of the loan. Many years ago, they used to say when you reached a 20% equity position, you could petition for that to be removed. After 2008, in that era there, they stopped that. Now it's for the life of the loan. The only way to get rid of mortgage insurance will be to refinance out of the FHA loan into a conventional loan. So I thought I would share that for you, that at least you know that going into it. But if you're only going to be in the house for 3 to 5 years and it's your first house getting started, guess what? It can work perfect. And if you need to use it, then use it. You can always refinance it. All right. So I just wanted to share that with you. So don't let this deter you from going forth and getting pre-approved and buying a house. Okay. FHA is a great program. Lots of people use it. And it can work with DPA programs, down payment assistance programs. Now, let's talk about USDA. That's the rural loans. Here we go. Zero down payment. Property must be in a USDA eligible area, and you can look that up online. Go to USDA, rural loans, and say, is this address acceptable? Will this work? And it'll say yay or nay. There are restrictions for buyers with an existing home. They are income specific. All right, this is really important. There is a median income that they look at. So maybe not. Seller can pay all your closing costs and prepaids, and the credit score is typically around 640 and above. There you go, USDA rural. Next is going to be our VA loans. All right, this is for eligible active military and people who are discharged. They put their time in, honorable discharge, and they have got VA eligibility. Watch this. And for those of you who are watching this that have VA eligibility, it is an incredibly great loan. Zero down, no monthly mortgage insurance, and it's for they loan you the money for a primary residence. It's designated for homes in move-in condition. All right, it's not for rehabbing. All right. Now, seller can pay closing costs and prepaids, and the seller, depending on the market, can also pay up to 4% towards a buyer's debt. Now, this isn't going to happen in a seller's market. I will tell you that right now. But when it wasn't a seller's market, I can remember doing these loans. I can remember working with buyers too as a realtor, and I've seen things that are just amazing to be able to get people to qualify, and sellers were willing to do it. Your VA eligibility is reusable. It's reusable, and that's something you want to talk to your lender about. Credit scores from 580 to 660 and above. So there you go. Great loan program, guys. Great loan program if you have the eligibility. Okay? Now, this is something I want to talk about, cash to close. This is important. What do I need to bring to the table? What kind of money, Mike, do I need to buy a home? All right, let's break it down into 3 sections. First of all, you need a down payment. The down payment could be, if you're using a down payment assistance program, it could be 0 all the way up to 5% or more. It depends on what you have. Then you've got your closing costs. Your closing costs are a one-time hard fee that you're being charged. I just wrote down a number of things that it could be covering here, all right? So this is closing cost. Then you have what they call your prepaids and your reserves. This is your homeowner's insurance and property taxes, because they've got to set that up and get a certain amount of money in there so that when it's time to make your pay the taxes and pay your insurance, there's enough in there with payments that you're going to be adding to it. So this is cash to close. So there's 3 areas. There's down payment, closing costs, prepaids, and reserves. Now, when a lot of people talk about closing costs, they put the prepaids and reserves and closing costs together. But you want to make sure, clarify that, okay? Are we talking hard costs, one-time fees, or are we talking the prepaids and reserves also? Remember to ask that, okay? All right. Now, let's break down an FHA purchase, okay? So let's take a purchase price of $200,000. Let's keep it real simple here. $200,000. The down payment is 3.5%. That's $7,000. The estimated closing cost is $6,000. And then the prepaids and reserves, which is taxes and insurance, is going to be a one-time in to begin with to set up that reserve account of $3,200. So you're looking right there at what? You're looking at a total of what? $9,200 total between closing costs and prepaids. But the seller, it was negotiated with by your realtor that the seller's willing to pay that $9,200 for you. Yeah, they're going to pay it. You put earnest money of $1,000 down. So now The only thing you have to worry about is your down payment. You already put $1,000 down, so you've got to bring $6,000 to the table. There you go. It's simple. I tried to put this down so it was very easy for you, and hopefully you can see that. It makes sense to you. It's not that bad, but I got some little things that I want to share with you. There are down payment assistance programs out there. There are. You might not have ever heard of this. Well, a lot of lenders don't utilize these. It's not something they want to deal with. But if you want more information about it, you can go to the Washington State Housing Finance Commission. I'm going to give you the address here in a little bit. But the one program that is huge is called the Home Advantage Program. It's a second mortgage program for qualified borrowers. All right, you got to qualify. And they normally will give you a loan of 4%, maybe 5%, on the first mortgage loan balance. Think about that. So if all of a sudden, if you go back to this slide right here, and you can get that loan, not only would you be able, 4%, look at that, 4% on $200,000 is what? $8,000. It'll be a little less, but it's more than enough to pay your down payment. You'd get your earnest money back. There's good programs out there. People are not aware of this stuff. We do these. I work with lenders that do these loans all the time. There are so many people that feel that they can't buy a home. I have clients that would love to be here to tell you right now. We met Mike and we didn't think we could ever buy a home. Next thing you know, 6 months later, we're in our home. We're buying a home. I think that this is what you need to hear. You need to see these things. There's the Home Advantage Program. There's the House Key Program. Home Choice is a beautiful program, especially if someone has a disability or a family member that's living there has a disability. It's a beautiful program to be able to help. These are programs that are available. If you want more information about it, will you call me? Will you text me? Will you get a hold of me? I can share more about this. And again, I know the lenders who do these. Now, down payment assistance resources right here. Go to WashingtonStateHousingFinanceCommission.org. Lots of good information right there. One of the things you have to do, though, you have to go through a home buyer workshop. Okay? Just so you know. Now, another buying mistake. No backup plan for housing. All right? I wish my son were here. He could elaborate on this. Let me tell you. He's a broker in the company. One of the things is that you said that you're going to be able to close and move in on April 15th. You're all set to go. I mean, you're ready. Now all of a sudden, something has happened. There's a delay. Something with the loan, something with the seller, something. Please make sure you have a backup plan, all right, to be able to have some extra time. I always tell people, listen, always try to close on your loan somewhere between the second or third week of a month, especially if you're renting. If you've given your notice, it gives you some move time. And if something goes on that it's going to delay, at least you're not pushed right up to the 11th hour and you've got 1 day to be out of your apartment. That's when the anxiety level starts to go up. Please don't do that to yourselves, okay? Please. Make sure you talk to your realtor about that. I know when I'm working with the buyers all the time, we make sure that we plan this out, even when we're going to be about to make an offer. Okay? All right. Now, let's keep going here. Okay, 5 tips to a smooth closing. Number 1, don't procrastinate in providing requested information. Did you hear me? If your lender asks you for something, don't procrastinate. Get right on top of it. If your realtor asks you for something, get right on top of that. Provide exactly what they're asking for. Don't think that you know what they want. Give them what they're asking for. No more, no less. Provide the best way and that means they can get a hold of you. That means how can they get a hold of you during the work hours? Get that game plan set up because it's very important that they have access to you during this time period of the loan process once you're in contract, okay? If you're going to be leaving town at any time, make sure you have a designated go-to person, especially when I'm working with a lot with military and I've got a soldier that is PCSing, maybe out of the country, whatever. It's very important. I always make sure they go over to JAG. They get a power of attorney for their spouse so that we can take care of things. Very, very important. This is critical, all right? If you're going to be going out on vacation, let us know. Let the lender know, let your realtor know right up front, please. All right? And if you're in doubt, call your loan officer. Okay, now what? I'm just about finished up here. You want to find the lender you want to talk to. You know, if you plan on buying, if you can read this yourself in the next few years, find the lender now. I know who the lenders are. I work with, I was a lender for 20 years. I work with the best. I know the best. And guess what? You'd be shocked with some of the stories that I could tell you where I have people that come in and go, I've got my lender. I've got my lender. And I'll say, hey, what are your closing costs on a $450,000 loan? They go, it's X amount of dollars, $13,000, $14,000. I go, really? I said, would you mind getting another opinion? And they get the opinion and it's like $7,500. What's up with that? So the thing of it is, I know the good lenders out there. So if you want to know who they are, call me, text me, let me know. I'll give you some referrals. Then you can go and you can interview. All right? Getting a pre-approval isn't a commitment to buy a house. It's simply to show you where you're at right now and where you can go and where you want to be. How's that? That's what I'm trying to say here on that slide. So with that said, let's talk. Give me a call. Give me a call. Let's go. Don't sit back there. If you want to know what it is, let's get you pre-approved. I can answer a lot of your questions. I'm here. My phone's right here on my desk. I'm ready to answer any of your questions and talk to you. You can text me. You can go down to my email. You can email me. But what I want to say is I want to say thank you. I want to say thank you for taking this time to listen to me. It's all about you. And that's what I want you to hear. Don't sit there. Don't procrastinate. Don't let your anxiety go up. Don't do that. Get yourself with a lender that you can trust. And once you do that, you're on your way. So thanks so much. Thanks for joining me. I'll see you soon.